Good morning. I'm Tim Nyland, and today we are resuming our normal weekly strategy call series with my thoughts on inflation, including the one key factor that no one is discussing and how to position your portfolios for 2021. Before we get started, please like, comment, and subscribe, and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. If you would like to do the kind of analysis you're going to see in this video, then you need to have a ZAT Portfolio Manager subscription, which includes both Zacks Advisor tools and the Zacks Research System. Today, I'll be utilizing the Zacks Research System to showcase a few economic charts with data transformations out of our 1 to 4 panel charts facility. Let's go ahead and get started. So if you've been looking at the Wall Street Journal or listening to CNBC recently or any of the other financial media outlets, you'll know that the transitory versus embedded inflation debate is hot, and it's also largely one-sided. And you'll see sensationalized inflation stories like these appearing in mainstream media outlets like the Wall Street Journal almost daily. The idea here is that you want to challenge everything. So based on what we're seeing in the media, you would think that everyone agrees that inflation is the highest in years and global manufacturing prices are skyrocketing. But you shouldn't worry, it is only temporary. And my thoughts are, is this really what's going on? That's what we need to challenge. Here's another example of sensationalism at its finest, and it continues to grow. A couple weeks ago, we did another strategy session. I commented on some CEO commentary, specifically from Costco and Berkshire Hathaway, about how inflation was now, creeping into the financial landscape. And now we see articles like this where companies are being scalded, quote, scalded by inflation. I understand it's a play on words for Campbell's soup, but this just seems to be escalating every week. But just because everyone agrees doesn't mean they have it right. And I think groupthink is becoming a real problem nowadays. Let's just take a look at some of the history here from the week of 5/19. You can see what's happening. The release from the central bank's latest policy meeting, the Fed had hinted at a larger overall policy review in response to the latest events of mounting inflation. So this is another word for saying the Fed was even surprised with the degree of inflation that's basically crept into the system. Then on 5/26, the city inflation surprise index chart, I've got it, I'm going to show it to you here in just a few slides forward, shows that both investors and economists alike have been caught off guard in 2021 when it comes to these actual inflation measures running hotter than forecast. Again, here, the key is surprise, and there are a ton of these inflation surprise index charts. The city inflation is just one. So my question is, and the whole point of this webinar today is, if investors and strategists are all in agreement with the Fed, and the Fed really has a handle on where inflation is heading, then why is it that most inflation index surprise charts are clocking in at greater than +2 standard deviations away from their mean consensus forecast? And again, this is for the latest reads on inflation. These are some of the largest inflationary surprises in history, and literally no one is talking about this stuff. So this is the best one here. It says, this is out of the Wall Street Journal. Most investors agree with Fed's inflation outlook for the next decade. Really? That's my comment. Really? So let me be sure I understand this correctly. I've got commentary here for you on the screen. We have recently experienced some of the largest inflationary surprises in history, but most investors agree with the Fed's inflation outlook for the next decade. I mean, that sounds dangerous to me. And it should sound dangerous to you as well. The bond market isn't worried about inflation. That's the headline of the story. And my comment is perhaps maybe the bond market should be worried about inflation. I don't know. My standpoint is I'm on the fence. I'm invested as if this inflationary event is going to be transitory, but I am very, very skeptical of everything that I see, read, and hear, and I am constantly on the lookout for any indicators that inflation is going to be embedded long term. So here's the real story. And this was actually an article that appeared later in the same Wall Street Journal that the prior Campbell Soup article appeared in. And it's funny that this commentary actually came from the CEO of Campbell Soup. And the real story here is that these inflationary pressures are more significant than expected, okay? And this coincides with what we're seeing with inflationary surprise. So the quote here, I have it highlighted in yellow in the article on the screen, but I've got it obviously typed up here to the left. We expected this to be a challenging quarter, but it was made even tougher as these pressures in some cases were more significant than anticipated. This is the real story, okay? And this is the evidence of that. This is the Citi Inflation Surprise Index. We are literally sitting at record high surprise. These are record levels that have never been seen, specifically in the last 20 years. So this inflationary surprise is an aggregate measure of a basket of goods and services. Now, the surprise charts that you see on inflation, there's a myriad of them. They range anywhere between 10 to 20 goods and services, and it's just literally looking at what was the estimate versus what actually came in terms of the inflationary read. And when you look across this broad set of commodity-based inputs, you can see the mean surprise for the last 20 years here in blue. And you can see +1, -1 standard deviation, +2, -2 standard deviation. The levels themselves don't matter. What matters is how high this current read is right now above the mean, the +1 and the +2 standard deviations. Again, these are record levels that we've just never seen before. So again, the idea here is if everyone is in agreement with the Fed about the outlook for inflation, then why is it that investors and economists have gotten this forecast for the most recent inflationary read so wrong? So that's what's got me concerned. That is why I'm really, really skeptical of everything that I'm reading these days. So people have asked me, Tim, what are you looking at to determine if inflation is being embedded long-term? I've literally had multiple emails come to me over the last several weeks from advisors and portfolio managers. So I'm going to give you my 3 things that I'm looking at, and then we'll wrap up with my 2021 inflation playbook. So the very first thing that I'm looking at is worker compensation. This is a vicious cycle. The labor force is really efficient at embedding inflation long-term through pay raises, especially when we have a labor force participation rate that has not recovered. And the idea is that we've still got a lot of workers sitting on the sidelines that need to get back into the labor pool. And the idea again is that these employers are going to have to continue to raise wages until it gets those workers off the sidelines. So those same workers are going to have more money to spend. So prices for goods and services are going to rise. And then this cycle continues to repeat itself and embeds inflation long term. So what we want to see is we want to see this labor force participation rate click back up. At that point, we'll get more of an equilibrium between supply and demand for labor. Number 2 is consumer demand. And this should definitely not be a surprise since the bulk of our economy is consumer driven. But what is different this time around is that we came out of this COVID-induced recession with record savings and money ready to spend. So we've not experienced this in recent downturns. So the current rates of spending have triggered an increase in demand across the board, literally for all goods and services. And prices are on the rise as a result. Now, obviously, coupled with that, we've had disruptions in supply chains across a multitude of industries, and that's just making matters worse. So what we've got to do for consumer demand is watch both savings rates and consumer spending, specifically in the coming months and quarters. We want to look at the trend relative to longer term to give us some idea if inflation is embedding itself longer term. And so what I've got on the screen is the Zacks research system chart. It's a 1 to 4 panel, only 2 panels active. Top panel is just the personal savings rate. And the bottom panel, this I'm using the personal consumption expenditures. It's the PCE read, but it's based off of the real GDP. So this is adjusted for inflation, and it's not core. So this is the total PCE. The Fed looks at both core and total and it doesn't really matter which one you use. What you want to do is look at this number relative to its 20-year median. And you can see that we're right shy of the 20-year median. Once we get over that 2.5% mark, then you're going to want to make sure that that additional spend is not necessarily coming at the expense of personal savings. And traditionally speaking, it will. We'll get a savings drawdown, and then that is going to be a sign that perhaps inflation is embedding itself more longer term, at least than we want. So that's what you want to look out for. Basically, these two lines more or less converging, even though they're not drawn on the same axis together. Number 3 is inflationary expectations itself, and this is definitely the most important one. This can become a self-fulfilling prophecy, and very, very quickly. And I have commentary on the screen here for you. If you don't believe me, just take a look at the recent market response to the change in Fed stance that is going to allow the economy to overshoot that 2% target for an extended period of time. This happened back in February, March, and immediately growth stocks took an absolute halt in as far as their valuation expansion, and equities responded overall as if we were already in a 2% plus inflationary environment. And relative to where we're at right now, inflation at that point was more or less nowhere to be found. I mean, it was, but not compared to what we're dealing with now. So the idea here is, why is this the case? And it's the case because if workers, consumers, and businesses believe that inflation is going to get worse, they immediately bid up the prices and wages in anticipation of inflation. And so again, another vicious cycle. They're literally fueling and fanning the flames of that inflation that they were originally fearing, and it literally becomes true, a self-fulfilling prophecy. So again, look no further than the countless number of inflation surveys available, and you'll see that there's some massive psychology behind this phenomenon. Here's an example of one that I thought was material. So University of Michigan, they do some great survey work. 1-year consumer inflation expectation clocking in at 4.6%. And this was just in May. This is literally the highest read since the China commodity boom post-Great Recession. 2013 was actually the last time we had a 3% long-run inflation expectation. We all know how that turned out. Until recently, obviously, it had been less than 3% since 2013. So one of the things I want everybody to do is make sure that you read the Zacks market strategy pieces. They are different, and they are really, really good. I've tried to stress this in the past. Our chief strategist and chief economist, John Blank, does a really, really nice job with our polling efforts. We at Zacks maintain working relationships with the entire sell side. And one of the things that we do different than everyone else is that we also maintain relationships with buy-side CIOs and incorporate it into our forecast as their input as well. So it's a very, very well-rounded forecast. And I've got on the screen just an excerpt of the monthly economic outlook. And you can see that we provide both sides of the story. We also give you the FOMC conference board forecast as well. Again, I want you to keep in mind the surprise is the real story here. And for the remainder of 2021, the surprise is going to continue to be the story. So look for what the inflation reads are coming in at in terms of actual versus what the estimates were. Again, if everyone believes in the Fed and everyone believes in the direction that we're headed, then why can't we get the estimates more accurate? We should not be seeing inflation surprise in excess of 2 standard deviations. So that's the concern. Want to tell you about a great opportunity to get some additional valuable expert perspectives on the economy and the market. Tomorrow at 11 a.m. Central Time, we'll be live casting our quarterly Zacks on the Call. It's going to be a great discussion. Again, I mentioned our chief strategist and economist, John Blank, and our director of research, Razmi, and both of them will actually be hosting the call. And they're going to look at how the post-COVID economy is shaping up and how inflation is factoring in. As always, they'll be offering their latest forecasts for earnings and the market. So you can easily register for the event. Just click on the link in the actual description to this webinar below. You'll find a link. And if you can't make it, don't worry about it. You can catch it on our YouTube channel starting next Monday. So either way, it's going to be a great call. I'd love for you to be able to see it any way you can. John and Shiraz do a really, really nice job for us. So we'll go ahead and wrap up with our 2021 inflation playbook. And again, you're going to see some trends in here. I'm not going to necessarily hit every single point, but what I do want to stress is, again, the importance of the margins, the importance of those ECP names that we use in the earnings certain portfolio. Those ECP names happen to be demand inelastic names. And what that means is that these companies their goods and services are going to continue to be in demand regardless of what the price is. So these companies stand a better chance at passing off higher costs directly to consumers and preserving their margins. Okay. We want to look for companies in terms of the equity space with those strong balance sheets and long track records of stable to increasing gross and net margins, especially in periods of inflationary times. ECP names obviously fit this bill. So when you're looking at dividend paying stocks, you're going to want to make sure that these companies have evidence of their ability to raise their dividend and continue to thrive in an inflationary environment. And again, those ECP dividend aristocratic names fit this as well. Real estate is one of my concerns during this recovery period. And the reason for that is that this time around is a little bit different. So in the past, offices, retail buildings, and other type of commercial properties, they've been really, really good hedges for inflation. But when you're doing it this time around, you got to make sure that these managers and these owners are actually going to be able to increase their rents. If they're not able to do that, their values will decline. So just be advised that if you're investing in REITs or making direct allocations into real estate, just know your market, know your industry, and know the ability for these owners and managers to actually increase rents in that industry. Okay. Obviously, I'm not a fan of bonds in this environment, but if it's necessary, I obviously like the shorter duration bonds. They're less sensitive to any change in interest rates due to inflationary expectations. Again, myself personally, I've invested as if this inflationary event is going to be transitory. However, I'm on the lookout for any signs that we're embedding inflation long term. Okay. So be sure to join me next week. Next week, I'm going to tackle the macro environment in a post-COVID world. And we're going to take a look at the implications for traditional asset allocation models. Traditional asset allocation models are breaking down, and I'm going to tell you why. So that's it for this week. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave me a comment below or email me at tnyland@zacks.com. If you'd like a copy of this slide deck, please email us, reach out to us. We'll get that to you immediately. You can also follow me on social media. I'm on LinkedIn and I'm on Twitter at Tim Nyland. If you're interested in getting started with advisor tools or the Zacks research system, or if you're looking to upgrade your current subscription, please contact our world-class support at advisortools@zacks.com and zrs@zacks.com. Thank you for watching, and I'll talk to you all next week.